Hello and welcome to Yadnya Investment Academy. Today we are going to discuss what can you do to protect your money in bond market or debt funds against the interest rate fluctuations. While all bonds are subject to interest rate risk, that risk is correlated to maturity length of the bond. As maturity length increases, so do potential price fluctuations. Conversely, the shorter the maturity of the bonds you invest in, the lower the risk of price fluctuations as a result of changes in interest rate levels. To understand this, let's look at this table. This table shows what would happen to the price of a bond selling at a price of rupees 1000 with a 7% coupon for several different maturities under three different scenarios. Interest rates rise modestly by 0.5% to 7.5%. Interest rate rise by 1% to 8% from 7% currently. Interest rate rise steeply by 2% to 9%. Table shows if interest rate rise modestly by just 0.5%, the price of 2-year bond changes very little. But even that modest rise results in a decline of 3.5% for a 10-year bond and a 5.9% for a 30-year bond. For the 30-year bond, the decline of 5.9% wipes out almost the total amount of interest income for an entire year. If such a sharp rise in interest rate occurs from 7% to 9%, decline becomes correspondingly larger. Clearly, if interest rate goes up, the holder of bonds with short maturities would be less unhappy than the holder of bonds with long maturities. Now, this phenomena happily operates in reverse. As interest rate declines, bond prices rises. That is the reason that bond investors anticipating a decline in interest rate position themselves at a long end of the maturity spectrum in order to realize the largest capital gains. In summary, both tables tells two basic principles applicable to bond investing. First, the prices of bonds and interest rates move in opposite directions. If interest rates decline, the price of bond goes up, and if interest rates rise, the price of bond declines. Second, bonds with larger maturities incur significantly higher interest rate risk than those with shorter maturities. That is a disadvantage if interest rate rise, but an advantage if interest rate declines. So with this knowledge, let's see ways we can reduce our risk in bond market investments. First is, if your investment horizon is clear, then you should always invest in debt fund whose average maturity matches with your investment horizon. For example, if investment horizon is suppose 2 years, then go for short-term debt funds. This will help you iron out impact of unexpected interest rate changes, something like which happened on February 7th, 2017, as explained in the part 1 of this series. Secondly, you can opt for funds like dynamic bond funds. Now, dynamic bond funds are typically recommended to debt fund investors who wants to leave the job of taking a call on interest rates to the fund managers. Dynamic bond funds invest across instruments of various maturities based on the view of the fund manager. Fund manager has a freedom to decide on his investment as per his view on various factors to the economy. So typically during rising interest rate cycles, they invest in short-term maturity instruments, and in the falling interest rate cycles, invest in long-term maturity bonds. Big risk here is the view of fund manager, because if he goes wrong, then the fund can incur huge losses. Third is, you can invest in floating rate bond funds. Now there are some debt instruments that carry a floating interest rate. In other words, instead of paying a fixed coupon rate to the lender, borrower pays a higher interest rate when the rates rise, and vice versa. At the end of the tenure, the borrower pays back the principal just like any other debt instrument. A floating rate debt fund invests in precisely these type of debt papers where the underlying interest rate keeps on changing. These type of debt instruments are not impacted much in changing interest rate scenario, obviously. But problem is that there are not enough floating rate bonds available in the market, and hence very limited pure floating rate debt funds are there in the market. Next is you can invest in long term fixed interest rate saving schemes like fixed deposits, PPF, senior citizen saving scheme. So if your investment horizon is long term, like 5 years or more, then it is a good approach to lock interest rates in such instruments for long term. Now, fifth way to manage your interest rate risk in bond market is to invest actually in equity. Equities are mostly a good hedge to interest rate cycles. When interest rate rises, cost of loan for companies increases, which impacts their profitability and therefore can impact their share price. Similarly, if interest rate reduces, cost of loan decreases, which means high profitability and could mean positive movement in share price. So equity markets can act as a good hedge against interest rate cycles. Now the last way is if your investment horizon is not clear and you want to keep your money for your floating requirements like your emergency fund, etc., then always choose short-term debt funds. These funds are not prone to very high interest rate fluctuations as well and give better returns than likes of liquid funds, and also have a very small exit loads, especially in first 3 months only. That is all we have on this topic. If you have any question, please do write in the comment section below, and do not forget to subscribe to our channel for more such videos. Have a great time ahead. Jai Hind.